On July 5, 1991, banking regulators in 7 countries executed a seizure timed to the minute. The coordination was deliberate. London could not warn Luxembourg. Luxembourg could not warn Abu Dhabi, and no branch manager anywhere could begin destroying records before the examiners arrived. In London, they walked into the Leadenhall Street headquarters and pulled the loan files. On some of the largest credits the bank had extended, the documentation contained a name, an address that resolved to a postbox, and a nominee agreement. The borrower, on paper, did not exist as an economic actor. The money, on paper, had gone out the door regardless. The question the files posed was structural. How does a bank lend hundreds of millions of dollars to entities with no assets, no operations, and no intention of repayment, and record those loans as performing for more than a decade? The mechanism at the center of BCCI is the nominee loan. Understand the legitimate version first. A nominee is a person or entity that holds an asset or enters a transaction on behalf of another party, the beneficial owner, whose identity is not disclosed on the face of the document. Nominee arrangements are lawful and common. A brokerage holds shares in street name. A lawyer signs a purchase agreement as agent for an undisclosed principal. The nominee is a legal shell around a real economic interest. A nominee loan, in ordinary banking, is a loan extended to a named borrower who is understood to be acting for someone else. The credit risk still attaches to a real party. Someone, somewhere, is expected to repay, and the bank underwrites against that party's capacity. BCCI inverted the instrument. In the structure, the enforcement record establishes the nominee borrower was not a shell around a real economic interest. The nominee was the interest. Loans were booked to individuals and companies who signed the paperwork, received the proceeds, and passed the funds to a destination the loan file did not disclose. Frequently, that destination was BCCI itself, or entities BCCI secretly controlled, or shareholders whose purchase of BCCI stock had been financed by the bank against the security of that same stock. What this means structurally, the loan was not an extension of credit against a borrower's capacity to repay. It was an accounting entry that converted a movement of the bank's own money into a reported asset. As long as the loan sat on the books as performing, the bank had manufactured value out of a transaction that transferred nothing. Now the architecture, the Federal Reserve's enforcement action and the subsequent court record establish how the machine was assembled. Follow it in steps. Step 1. BCCI needed capital, and it needed the appearance of independent ownership. To acquire American banks and to satisfy regulators that its shareholding was diversified, it required shareholders who appeared unconnected to the bank. So the bank recruited nominees. Prominent individuals in several documented cases agreed to hold shares in their own names. Step 2. The shares were not purchased with the nominee's money. BCCI lent the purchase price. The nominee signed a loan agreement, the loan proceeds bought BCCI-related stock, and that stock was pledged back to BCCI as collateral. The record establishes this pattern in the acquisition of American banking institutions, where BCCI's secret control was routed through shareholders of record who had borrowed from BCCI to become shareholders in the first place. Step 3. Consider what the collateral actually was. The loan was secured by shares whose value depended on the solvency of the bank that had made the loan. If BCCI failed, the collateral was worthless. The security interest was circular. The bank had lent against a claim on itself. Step 4. The nominee had no obligation to repay from personal funds, and in many cases, no expectation of doing so. Interest accrued on the books. When payment came due, it was frequently serviced by extending a further loan. This is the role. A loan that cannot be repaid is refinanced by a larger loan, and the accrued interest on the first becomes principal on the second. Each role increased the reported asset. None of it moved real money toward repayment. Step 5. The same nominee structure serviced a second function. BCCI carried losses it could not disclose. Treasury trading losses running to hundreds of millions and loans to insiders that would never be recovered. These had to be removed from the visible balance sheet, so the bank parked them. A loss was recharacterized as a loan to a nominee entity. The bad asset left the trading book and reappeared as a receivable from a borrower who existed only as a name and a nominee agreement. The Waterhouse report to the Bank of England, later summarised in the public record, described a bank in which the accounts did not reflect reality. What the auditors were describing, in structural terms, was a balance sheet where a material portion of the loan portfolio consisted of these constructed receivables. The assets were not claims on borrowers. They were the bank's own losses, wearing the costume of loans. Step 6, and this is the load-bearing element. The structure required that money circulate between related entities without leaving the system. BCCI operated through a fragmented corporate architecture, a holding company in Luxembourg, operating subsidiaries, a separate entity in the Cayman Islands, International Credit and Investment Company, ICIC, which the record establishes functioned as an internal instrument for holding shares and funding the nominee arrangements. Money moved from the bank to ICIC to nominees to shareholders and back to the bank, and at each junction the transfer was recorded as an arm's-length transaction between independent parties. Draw the org chart. Luxembourg Holding Company at the top. 2 principal auditing firms, each seeing only part of the group. Operating banks in London and elsewhere. ICIC in the Caymans as the captive funding and shareholding vehicle, and radiating outward, the nominees, individuals and shell companies holding stock they did not pay for, borrowing money they would not repay, secured by collateral that referenced the bank itself. Why did the gatekeepers miss this, and miss it for years? The answer is structural, and it begins with jurisdiction. BCCI was incorporated in Luxembourg. Its principal operations were in London. Its capital and its controlling interests traced to the Gulf. Its funding vehicle sat in the Cayman Islands. No single regulator had a consolidated view of the entire group. This was not an accident of geography. The record establishes that the corporate structure was arranged so that no one supervisor held the whole picture. Luxembourg had chartered a bank whose real business was elsewhere. The Bank of England supervised a branch network, but not the consolidated parent. The group had, in effect, engineered a supervisory gap and lived inside it. The audit function was split along the same lines. 2 firms audited different parts of the group. A nominee loan is detectable only if the auditor can trace both ends of the transaction, the money leaving as a loan and the money arriving somewhere the borrower does not disclose. When the 2 ends sit in different entities audited by different firms in different jurisdictions, the round trip is invisible from either side. The auditor examining the London loan sees a facility to a named borrower with pledged collateral. The auditor cannot see that the proceeds return to the group through ICIC in the Caymans. The fragmentation was the concealment. Consider what would have had to be true for earlier detection. An auditor would have needed consolidated visibility across every entity in the group, including ICIC. A regulator would have needed authority over the parent, not merely a branch. And someone would have needed to test the collateral by asking a single question. If this loan is secured by BCCI-related shares, what happens to the security if BCCI fails? That question exposes the circularity immediately. The record indicates it was not asked or not answered for a long time because no gatekeeper had both the mandate and the visibility to ask it. The rating and analytical scrutiny that would apply to a public issuer was also muted. BCCI was privately held. Its reported growth was rapid and its geographic reach was wide, and for a bank presenting itself as serving markets that established institutions underserved, rapid growth was consistent with the story it told about itself. The loan portfolio's constructed receivables did not announce themselves as distressed. They were current because the roles kept them current. The unravelling. When the auditors finally obtained enough consolidated visibility to trace the transactions, the picture assembled quickly. Waterhouse, engaged to examine the group more comprehensively, reported to the Bank of England that the accounts did not reflect the true financial position and that there was evidence of a pattern of fraudulent transactions. The report established, in substance, that a large portion of the loan book was fictitious or unrecoverable, and that the losses had been concealed through precisely the nominee mechanism described. That report is what converted a supervisory concern into a coordinated seizure. On July 5, 1991, regulators moved simultaneously across jurisdictions specifically because the group's fragmentation, the same fragmentation that had hidden the fraud, now created the risk that assets and records would be moved between jurisdictions the moment any one branch was closed. The timing to the minute was a direct response to the structure. In the United States, the Federal Reserve issued findings and penalties establishing that BCCI had secretly and unlawfully acquired control of American banks through nominees, financing the purchases with its own loans against its own stock. The record established that the shareholders of record were nominees for BCCI, that the disclosures to United States regulators were false, and that the ownership BCCI had represented as independent was in fact controlled by the bank itself. Once the mechanism was exposed, the collapse was immediate because the constructed assets could not survive daylight. A performing loan stops performing the moment it must be repaid from real funds rather than the next roll. A collateral pledge referencing the bank's own stock is worthless the moment the bank's solvency is in question. Every element that had held the structure together depended on the structure continuing. When the rolls stopped, there was nothing underneath. The bank was insolvent, and the record establishes it had been insolvent in economic reality long before the seizure. What the case establishes as a structural matter is this: a loan is only an asset if it represents a claim on a party with the capacity and obligation to repay. BCCI demonstrated that when the borrower is a nominee for the lender and the collateral is a claim on the lender, the loan is not an asset at all. It is a mirror. It reflects the bank's own money back to it and reports the reflection as value. The mechanism was defeated by consolidation, and that is the direct regulatory legacy. The BCCI failure produced the Basel Committee's minimum standards for the supervision of international banking groups, establishing that a banking group must be subject to consolidated supervision by a home country authority with the capacity to see the whole entity. In the United States, the Foreign Bank Supervision Enhancement Act of 1991 conditioned foreign bank operations on the existence of comprehensive, consolidated home supervision. The finding is narrow and it is precise. The nominee loan was not defeated by anyone reading a single file. It was defeated by the principle that no part of a banking group may be audited or supervised in isolation from the whole, because the fraud lived in the space between the parts.